Recently, I made a video called Stop Trading Options Immediately. I know that's a little bit of a bold title because we all love to degenerately trade options. Hey, it's fun. You can spend a little bit of money and potentially make a lot, even though the odds aren't necessarily the best. I understand the appeal. But within the video, I explain why you should at least consider trading futures, something I love to do. Now, in all reality, options, futures, I think they all have their own pros and cons, so it's best for you to learn a little bit about all of them. But within that video, I explained there are some clear benefits to trading futures that at least I wish more people knew about. So within that video, a lot of people asked me to make this exact video. What are futures? How do you trade them? And basically answer all of your introductory questions. So with that being said, that's exactly what I'm here to do. My goal is by the end of this video for you to know what futures even are, where and how can you even trade them, and hopefully I'll be answering most of your initial questions. So with that being said, sit back, relax, and let's ride. Now, according to the interwebs, a futures contract is a legal agreement to buy or sell a particular commodity asset or security at a predetermined price at a specified time in the future. That's actually how a futures contract even got its name. A buyer and a seller are agreeing on a price now for an underlying asset to be delivered in the future. Now, when I say underlying asset, I don't want you to think about equities such as Apple, Tesla, or even Nvidia. I want you to think about commodities, and there are a lot of them. There are agricultural futures, including coffee, milk, and sugar. There are energy futures such as crude oil and natural gas. There's even metal futures, think of gold, silver, and copper. There's currency futures for all the major national currencies, think of the US dollar, the British pound, or even the Japanese yen. And finally, last but not least, in fact, they're my personal favorite, we have financial futures, and this includes things such as the S&P 500 and the NASDAQ 100. So now that we got that out of the way, it's pretty fair of you to ask, why does this even exist? Why do people trade this? What in tarnation is going on? To better answer that, we need to take a further dive into what futures contracts really even are. The buyer of a futures contract is taking on the obligation to buy and receive the underlying asset when the futures contract expires. The seller of the futures contract is taking on the obligation to provide and deliver the underlying asset at the expiration date. Important side note here, even though we're using the term expiration, a term that's obviously well known in the world of options trading, futures themselves do not have Greek values. There's no theta, delta, gamma, or anything like that, just so you know. Now that I've hit you with all the fancy definitions, you're probably thinking to yourself, I kind of get it, but not really, something's missing, and I totally hear you. I was there myself when I was first learning about futures, so let me hit you with an example to better explain things. And for this example, you need to know that there's two major types of groups of people who trade futures. You have hedgers and you have speculators. Just so you know, people like you, people like me, we're speculators, but to better understand why this market even exists, you have to understand the hedgers. Let's say that you own a thriving Texas roadhouse. I'm saying you're slinging baby back ribs every single day of the week like it's your job, because it is your job, because you own and operate a thriving Texas roadhouse. When it comes to figuring out your profit, obviously the cost of meat is pretty important to you. Let's just say for this example, we're talking about live cattle. You buy the meat and then you turn it into delicious goodness and sell it to your patrons, and you're keeping the difference. Now that's where things get a little bit complicated. The cost that you have to pay for the meat is not stagnant. It goes up and down because of real world developments, and because of that, it can be difficult to make accurate projections for your business. But obviously, you're a smart Texas Roadhouse owner and operator, and you don't want to deal with those unknowns, so you come up with a better solution. You buy a futures contract on the meat that you need at today's price, and you know it'll be delivered to you in the future at the agreed upon price, thus taking out some of the unknowns of the market. So that's how someone who's hedging would use the futures market. Obviously, there's many other examples of this in the real world, such as airlines and oil, such as farmers and wheat. Like I said before, most of us aren't actually hedging. Most of retail traders, people like you and me, are actually speculators. Now, I know being a speculator sounds fancy, but it really just means you're an active trader. The best way I could explain this is actually using an example from the world of options. You know how we're all degenerately buying and selling calls and puts, but it's rare to actually exercise? Well, the same thing is true in the world of futures. Most of the time, a speculator is just betting on the trend to the upside or to the downside, and we're not really exercising. That would be the term used in the world of options, and the term that's roughly the equivalent in the world of futures is accepting delivery or taking delivery. You don't have to take delivery of the gold or the sugar or the oil or the orange juice or whatever commodity you're trading. You could buy at a low price and ideally sell at a high price, or obviously even do the inverse. But hey, if you want to take delivery on a bunch of live cattle, all the power to you. So where can you trade futures? The answer is most places. Most brokerages offer you the opportunity to trade futures. When you're signing up, there's an equities option, there's an options option, and most of them have a futures option. Now, I'm not here to show you a particular brokerage. Trade futures wherever you want, but I would recommend starting out with a paper account. And I'm talking fake money. Don't trade with real money because there are some nuances to the world of trading that there's just a bit of a learning curve. And I think it's better to get over that learning curve, not risking actual money. So please, please, please start on a paper account. On that particular note, Interactive Brokers, TradeStation, even NinjaTrader are 3 of the many options available to you that offer a pretty quality paper trading, or if you want to call it simulated trading account services. Now, we're not going to have the time in this video to go through all the nuances of futures trading, but I want to touch on some of the key ones that's a little bit different from the world of trading equities or options or even crypto. First of all, futures contracts trade on their own wild schedule. In fact, some futures trade on different schedules relative to other futures contracts, so don't be thinking about the classic Monday to Friday, 9:30 to 4 p.m. Futures commonly trade in a much larger window. This next one's a pretty wild one. It took me a second to wrap my head around it, but I think I could explain it pretty well. Let's say you're looking at a stock, XYZ, and it's trading at $100. It means you have to put up $100 to buy XYZ, and hopefully it goes up in price and you could sell it at a higher value. And let's say you sell it at 105. That means that someone paid $105 to you to buy it off of you. That's not exactly how futures trading works. Let's say you're looking at the S&P 500 on the futures market and it's currently trading at 4,500. That doesn't mean that you pay 4,500 per contract. It's not based on the underlying value of the asset. It's more so based on the volatility of the underlying asset. Let me better explain that because it's a little bit confusing. Let's say that the S&P 500 is trading on the futures market at 4,500 and then it goes up to 4,600, but the volatility is roughly the same. Well, to get in at either of those points, 4,500 or 4,600, it would cost you the exact same. You're not buying the underlying asset. In this example, the S&P 500, you're buying a contract that represents the underlying asset in the future. Now, I know that's still probably a little bit confusing, but what you really need to know is that to get into these future contracts, whether you're long or short, it's not really based on the value of the underlying asset, but rather the volatility of the underlying asset. At the time that I'm filming this, to get one contract on the S&P 500, if you're swinging it overnight, will cost you around $12,000. That's at least what you just have to have in your account. But if you want to day trade it, it's actually a tenth of that, around $1,200. So essentially, your futures trading account has to have enough money in it that represents the margin for the position. That's what allows you to either go long or short whatever contract you want to. Just so you know, this margin requirement has a large range depending on the futures contract that you're talking about. Some futures contracts are as cheap as $100, and then some are tens of thousands of dollars. You should also know that futures contracts are highly leveraged, but they're leveraged at different rates relative to each other. For example, the S&P 500 futures contract changes $50 for every point. So if it was trading at 4,500 and you go long and then it goes up to 4,501, you didn't make $1, you actually made $50. But you could also understand how if it goes against you, it could go against you pretty quickly. For another example, let's say you decide to short crude oil on the futures market and it's currently trading at $80. If it were to drop to $79, you wouldn't be in profit by $1, you would actually be up $1,000. My point in bringing these two examples up is that futures are a very leveraged derivative, and unfortunately, they're leveraged at different rates, so it's not like a one-size-fits-all type of a situation, which means that you have to have a bit of knowledge of the actual futures contract that you're trading, which once again, I think the best way to figure that all out is by using a paper trading or a simulated trading account. All in all, when done properly, you can make a boatload of money trading futures. I think it's easier to be successful in the world of futures trading than options trading. My main reasoning for that is theta decay, but if you're more curious about really all of the pros and cons of the two, make sure you check out that video that I alluded to at the start of this one called Stop Trading Options Immediately. I'll link it in the description of the video. Now, after watching this video, I hope that you feel a bit more comfortable in the world of futures trading, but I totally understand if you still have some questions on your mind, or maybe this video prompted some new questions, so ask away. Put them in a comment below and I'll do my best to answer all of them. If I'm seeing one question being asked a lot, and feel free to do that, I'll probably just make a whole video of it. But if you made it to this point in the video, I just want to say shout out to you, you're a legend. And I also wanted to let you in on a little bit of an idea of where I want to take things. I want to continue to teach you about futures trading, and then I want to intersect that with the world of AI systematic trading, because personally, that's where I think the real money is at. So look forward to that in the future. Once again, if you enjoyed this content, it would be awesome if you could like, subscribe, comment. That just helps me out with all the algorithm stuff. So feel free to do that. I appreciate your time. I'll catch you in the next video.